Welcome everyone to this webinar today in our member development series. I'm really excited about the content that we'll be covering. We have a lot to cover, so we wanted to go ahead and get started, and I'm going to start with introductions and then I'm going to hand it off to Jerry to begin. So we're going to be talking about nonprofit governance and tax deductions, which we all can benefit from. So Jerry Holmes received her Bachelor of Science from Oklahoma State University and her Juris Doctor from University of Oklahoma in 1995. After practicing for several years outside the nonprofit realm, Jerry's volunteer work led her to the discovery that the unique nature of tax-exempt organizations called for a specialized legal advisor. But due to the small nature of many nonprofit organizations, they couldn't afford to keep an attorney on staff. So in 2004, Jerry founded Nonprofit Solutions as an answer to this need and has remained a legal advisor to tax-exempt entities, including us, the CSD, ever since. As a lawyer for tax-exempt organizations and government entities, Jerry helps create a foundation for future growth by ensuring legal compliance and strong governance. Her services extend beyond simply providing legal counsel to organizations, and Jerry's goal is to ensure ongoing success by taking a holistic approach to organizational health. So next, after Jerry's presentation, we'll hear from Alex Towler. Alex received her Bachelor of Science from Oklahoma University in 2015 and her Juris Doctor from the University of Oklahoma in 2018. And while at OU Law, Alex interned at the Oklahoma Center for Nonprofits, Summit Financial Group, and Blaney, Tweedy, and Tipton. She also served as a research aide for Judge Patricia Parrish at the Oklahoma County Courthouse. Alex received her Chartered Advisor in Philanthropy in June of 2019. And at Nonprofit Solutions, Alex has helped to support overall organizational health by providing counseling to donors in the area of planned giving, reviewing contracts, drafting and implementing effective personnel and programming policies, training supervisors, conducting human resource audits, and conducting informal personnel investigations. In addition to her work at Nonprofit Solutions, Alex teaches planned giving for the Master of Arts in Nonprofit Leadership program at Oklahoma City University. And she has also gone out on her own since then. So I will let her talk a little bit more about that. So with that, just a couple housekeeping rules. If you have questions that come up during the presentation, I encourage you to put those into the question and answer box. That way you won't forget. And at the end of the presentation of both Jerry and Alex, we'll go ahead and address those questions. I'm really excited to hear from you both today. So with that, I will hand it over to you, Jerry.
Thank you for having us. Alex and I both love teaching. And so due to our time constraints, I'm going to jump right in. You will see that I do have a little disclaimer down here that this is for educational purposes only. I'm not giving anyone actual legal advice today. And then Kelly, I think I just need to let you know when we're ready to go to the next slide, since you're controlling our slideshow. Is that correct? There we go. All right, so we're going to start with, and it's not quite going, Kelly, not quite yet. We're going to start with there we go. Why does the IRS have such an interest in tax-exempt organizations, and what has kind of been changing in this area? So what happens is the government is losing revenue because our organizations are not paying income tax, and because when we're a tax-deductible entity, all those donations that come into our organization are providing a tax benefit to the donors. So they're not paying taxes either. When you combine those two together, it is well over $500 billion in lost tax revenue to our federal government, and it actually goes on the federal budget as a line item expense. And so our legislators are taking notice. The bigger that number gets, and it continues to grow. And then we have a Supreme Court case that says because we're not paying taxes, that we are federally subsidized, which allows the federal government to get into our business because they believe that we're not paying taxes, and therefore the money that we have is basically theirs. Now, this really wasn't a big issue until a little bit more recently, but back in 2005, the IRS went to Congress, and so we have all these tax laws on the books, and we really don't have enough agents to do anything about it or to enforce anything in the tax-exempt world. By 2007, they had an additional 6,000 IRS agents that were auditing nonprofits. And shortly thereafter, an audit list came out for the IRS auditors that dealt with governance, not the money. They knew how to do that, but governance, such as how many times is your board meeting? Do they have committees? Do they give authority to committees to act on behalf of the board? And then those questions started showing up on the tax return, primarily the large tax return, the big 990 tax return. And so if you give committees the authority to act, or anyone the authority to act on behalf of the board, you got to report it in the tax return. And that was really something that kind of threw everybody for a bit of a loop. Then they started putting out white papers on governance, what they expected governing bodies to look like. So Kelly, let's go on to the next slide. And so in a nutshell, here's pretty much the responsibilities of the board. Now, pretty much all state statutes, all states have this type of responsibilities in their statutes. Now, the good news is state statutes across the United States protect nonprofit boards, and they do it a little bit differently in each state. So it's important to go to your state statutes and look at the protections afforded by your particular state. For instance, in the state of Oklahoma, Kansas, Texas, kind of in the Midwest, they are very protective of their boards, and so pretty much across the board. But in Washington state, if you get sued by an employee and you owe back wages in the state of Washington, the board members personally can be held accountable for that. So that is just one of those variations. California is a little bit different. Louisiana is a little bit different. So it's important for you to go look at that. But I'm going to kind of stick with the three basic areas. And the first we're going to cover is the duty of care. And I have a slide for each one of these, by the way, so we'll dig into them a little bit deeper. But the duty of care, basically, it means that your board members are going to be making good faith decisions, right? They're going to do their homework. Then there's that duty of obedience, and that is being true to the tax exempt purpose of the organization. And then there's the duty of loyalty, and that is your expect to act in the best interest of the organization, not your own personal interest. And the responsible party is the governing board as a whole. And directors acting independently actually create risk for the entire board. And such actions will not be covered under D&O insurance. And this has been an issue that has really been growing thank you, Kelly, on what is an action of the board. And one of the things that has happened with COVID that we've noticed is people like me that like to know exactly what's going on and being able to have some control. When we feel like we're out of control, we start gathering up everything around us. And that seems to be happening a lot. And then, but unfortunately, how that's playing out in the boardroom is we will have a board member that decides, yeah, I can direct an executive director. I can tell them what to do. Or the board thinks we should go in this direction, and I think that's completely wrong. So I'm going to tell staff or sign a contract or whatever that the board hasn't voted on. And if individuals are doing that, it's very important that we let them know that that is not an action of the board. And therefore, if things go wrong, they are operating outside of the board. They're operating outside of the protection of state statutes, and they are hanging out there on their own. Now, I have a couple people that I know that just simply can't help themselves, and they are not going to give up this practice. So I tell them, in that case, knowing that they're not going to be covered, that they better go get insurance on their homeowner's insurance, a rider to cover their board service. So hopefully they may be protected, maybe not, if they're acting outside of a board decision on if something goes wrong. So I just want to make that really, really clear. And then also, please be advised that the board of directors are the ones that are listed on the 990 tax return. So an issue that I dealt with this morning was a board has hired an advisor to the board, who's not a director, but that advisor has been going in and directing staff, not covered under D&O insurance, right? So we have to be very careful on who's actually guiding the organization. Okay, Kelly, we're ready to go on to duty of care. So when we're talking about duty of care, here's just an example. Are we thinking, if we're going to spend money, are we making sure that we're paying fair market value? That's what FMV stands for, fair market value. Because our tax exempt organizations cannot benefit private individuals. Cannot benefit private individuals. So we really need to make certain that we are paying fair market value or less for the services that we are receiving. Now, that may be that we all get on our cell phones and call around during a board member or during a board meeting to try to determine if we're getting a good deal or not. We need to at least make sure that that's showing up in the minutes that we took some action, had some discussion to try to determine whether this was in the best interest of the organization. Other questions we need to consider is conflict of interest. Do we have any conflicts? Are we doing business with board members? Is there a need for the project? Is it within our budget? If it's not within our budget, who's going to fundraise for it? How are we going to pay for it? And does it meet the purpose of the organization? These are all questions that we need to talk about. And then we need to have that discussion in the minutes, because the minutes, people aren't going to remember 5, 6, 7 years from now what you decided, what you talked about. So it's really important that we have a line or two. It doesn't have to be a big, long discussion, but a line or two on why we made the decision that we made, because those minutes will be your first line of defense if things do not go right. All right, let's go ahead and go over to the next slide, and that's that duty of obedience. So your organization filed a Form 1023 with the IRS, and when you did that, you told them what you were going to be doing, and you gave them your tax exempt purpose. And that's the tax exempt purpose that we have to work within. So if your purpose is ABC, you can't do ABC and D, right? If you spend money to further D, then we're working outside of our tax exempt purpose. And often that's called mission creep. However, the IRS calls it something different. If it's a substantial amount of money, what the IRS considers substantial, which they don't tell us, by the way, case law is going to say anywhere from 5% to 20%. So, but if you're spending substantial amount of money outside of your tax exempt purpose, the IRS calls that a diversion of assets. And technically that money does not fall under your tax exempt purpose, and therefore you should be paying taxes on that money that comes in and goes out. You'd be filing 990T tax return and paying taxes on that. So really go back and look at that tax exempt purpose, look at the programming you're doing, and make sure it all fits. Now, we can amend our tax exempt purpose. And when we do that, it's usually through our articles of incorporation. And if we got a very generic purpose there, that's okay. We may not have to amend, but we at least have to notify the IRS on Schedule O of the 990 tax return that we have expanded our tax exempt purpose. And that's how we report to the IRS. Now, there's also this issue that if we amend our bylaws, there's significant changes to the amendments of the bylaws also have to be reported on Schedule O of the 990 tax return. So let's just make sure that we're making those amendments or we're expanding our purpose, that we are communicating that with our CPA. You need to be in constant communication with the person that's doing your 990 tax return and letting them know if you're making changes, so then they can make sure that they're reporting that appropriately to the IRS. All right, let's go on to that duty of loyalty. And here are all the questions on the 990 tax return that the IRS has questions about the duty of loyalty And basically, we're talking a lot about doing business with your board members or their family members. And this is something that the IRS takes very seriously. So let's go on to the next slide. So when we're talking about doing business with board members, right, I really don't want you to do it. Anytime an organization gets into trouble, one of the first things the IRS is going to look at is money flowing out of the organization to a board member or officer or significant donor or things like that. They're going to look at the money flowing out. Now, the money flowing in is good, right? Every board member should be writing a check or making a donation to the organization, a personal financial contribution, every board member, because grant applications ask, do you have 100% giving on your board? And if you don't, and your own board members won't support your organization, why would anybody else? So it's important that money flows in from the board, but I'm talking about the money flowing out to board members. And guys, this could even be a reimbursement, right? If we're going to reimburse a board member, then there is no benefit, there is no conflict. However, we better have receipts and all kinds of information to back that check up of why that board member is getting money out of the organization. If we choose to pay that board member for services rendered, it is not illegal. It's not illegal. However, what kind of proof are we going to have that that board member is not receiving a private benefit? That's what we're after. And again, we're back to collecting those bids, looking at information on other organizations or other people, what we would pay them for fair market value. Then we're going to discuss it. And the interested director that we're looking at paying is going to leave the room while the discussion and the voting takes place. Now, you're not subject to open meetings or open records. By the way, you're funded right now. But if you were, then we would have to do that vote in an open meeting. So we don't have to worry about that. So that means that board member can also stay out of the boardroom while the voting takes place. And then the minutes are going to reflect the application of the conflict of interest policy, the board discussion, the information that the board based its decision, and the minutes is going to reflect everything, the discussion, the votes, including the dissenters. And then the interested directors are going to be reported on page 1 and page 6 of the 990 tax return, and possibly schedule L of the 990 tax return. So you can kind of tell that if you don't have to write your board members checks, it's going to benefit your board members. We're not trying to be mean or ugly to your board members. We're trying to protect them. And then also just having someone step off the board so we can go ahead and hire them does not really work anymore. In 2009, the IRS changed that loophole, which I found very disturbing. And now there's a 5-year look back period. So it's a 5-year look back period on the date of the transaction. So if the person isn't on the board at the date of the transaction, but they were on the board 5 years prior, we still have to report. Okay, so let's make sure that we are protecting those board members if we have any money flowing out of the organization to the board members. All right, so Kelly, let's go ahead and go on to that next slide. And here's where I'm going to spend quite a bit of time. Your minutes are legal documents, and it is extremely important that you are keeping accurate minutes. So we are going to make sure the date, the time, the location, all of that is found in the minutes. Also, all those attending and all those absent. Now, when I do bylaws, I state that if you are absent for 3 meetings in a row, you are deemed to have resigned from the board. On your 3rd absence, you are no longer a board member. That's not being mean. That's being protective of you. Because remember, we have that duty of care, duty of loyalty, duty of obedience that we have to follow. You cannot fulfill your duty of care if you are not at the board meeting making decisions. There are attorney generals that have said if you are not looking over your financials at least quarterly as a board, that you are breaching your fiduciary duty of care to the organization. So if I was a plaintiff's attorney and I go to sue your organization, I'm going to ask for all your minutes and I'm going to look to see which directors have not been showing up. And if they're not showing up, then I'm going to say they're breaching their fiduciary duty of care, and I should be able to go after their personal assets. So although it seems harsh that we would throw you off a board if you miss 3 meetings in a row, it's really because we're protecting you. Then we can always vote you back on. So please understand that if you get a call that says, hey, you've missed 2 meetings in a row, if you miss another one, then you're going to be deemed to have resigned. That is not somebody being snarky. That is not somebody being ugly. That is somebody being protective. And then we really want our quorum requirements to be a majority of the board, because a lot of people will go, well, we've got a lot of absences, we can't make quorum, so they reduce their quorum to 30% or sometimes even lower based on state statutes. And again, that can be harmful to our board members. It gives us the idea that we don't have to show up. Then we also want to make sure the motions are recorded in the minutes, and then the discussions, and then the voting results. Now, sometimes we're going to have some discussion to help really bring out the exact wording of that motion, and that's okay. We can talk about the motion a little bit. We can pull the say we're withdrawing the motion, reword the motion, but then once the motion has been made and seconded, we want to make sure we have additional discussion. And on discussion, again, not a lot of information, but an example is I was working with a university foundation. They had a finance committee that had full authority to act on behalf of the board. So the minutes went into the corporate records, just like board minutes. And they weren't putting anything in there because as for-profit businessmen, every attorney, including this one, would tell for-profit businesses, don't put stuff in your minutes, right? Just show what the decisions are because you can be sued on those. Nonprofits are different. Because you have all this statutory protection, you only want a line or 2 in there that show that you are acting in good faith and fulfilling your fiduciary duties. So the example that I use is this university foundation. I'm making up the investment, but they said we're going to invest $250,000 in an apartment complex in North Carolina. And my question was, whose child gets to live there for free? And they said, why would you think that? You haven't given me any reason not to think that. And they said, we're investing in that because it's outperforming the market by 10%. That's what goes in the minutes. We're doing this because it's outperforming the market by 10%. That's the type of detail that we want in the minutes. Of course, the voting results, and if there's any conflicts, we want to be addressing those, just like what we talked about in the prior slide, and then dissenters and people abstaining. Now, guys, another issue is if I can look back through years of minutes and no one has ever dissented, no one has ever disagreed, you have to wonder if you're really fulfilling your fiduciary duties. Are you really having discussions? Or are you really just, rubber stamping everything? It is okay to dissent. If you dissent and the board votes for the action, now you have to change your tune completely, get on board, and back up the decision of the board as a whole. And sometimes that's hard because you think, well, I got outvoted, I'm upset about it, now I'm not going to help. No, not a good board member. Once the board has made the decision, you have to get behind the decision of the board. If you feel like you cannot do that, you need to consider resigning. And then reports given. If you're not going to attach the reports to the minutes, give a couple lines about what the reports are. You may want to attach documents that are provided. Sometimes that's good. If it's a financial report, probably not, because you're going to have access to that. And then future action. If you're going to table something, let's make sure we don't forget about it and it ends up being a gross admission and we are not fulfilling our duty of care. So make sure that gets to go somewhere. Time the meeting ends. And again, that's to avoid parking lot meetings, the meeting after the meetings. Those are not an action of the board. And then I want 2 people signing, usually the person presiding over the meeting and the person taking the minutes. And that's because Alex and I work with a lot of embezzlement. And people that embezzle money will go in and alter the minutes after they have been approved by the board, but prior to going in the corporate record. And then they'll use those minutes to go get a credit card, take out a loan on behalf of the organization, do things they shouldn't be doing. And then we want some consistent detail. So let's go ahead and go to that last slide because I'm running out of time. Here's the responsibilities of the board. Here's what you're supposed to be doing. Strategic planning and mission, obviously, financial oversight, compliance, leadership, hiring and firing an executive director, salary, evaluation, succession planning for the executive director. If you have multiple employees, the board only has 1 employee, and that is the executive director, not the other staff. And you don't micromanage your executive director. That's how you lose them. And then, of course, setting policy, employment policies, volunteer policies, governance, finance, program policies, all of those types of things. So the employment, volunteer, lots of program policies. Alex does a lot of that. And then I usually do the governance and financial type policies. So that's kind of the type of work that Alex and I do, is a lot of these policies. And then also fundraising. If you're on the board, it is your job to fundraise and help generate a contact list. And then that is kind of where I'm going to wrap up. That's kind of my 30 minutes that I have. And so now we're getting into fundraising, into what Alex is going to talk to you a little bit about.
That was so good, Jerry. Thank you so much. I was scribbling down notes the whole times, and I have some questions myself that I want to ask. So I just want to encourage all of you. I saw that there's one question in the Q&A box. If you have any questions coming out of what Jerry spoke about, go ahead and put those in now so you don't forget. And then after Alex presents, then we'll go ahead and address those questions. So Alex, take us away.
Okay, perfect. Thank you so much, Kelly. And thank you, Jerry, and also my mother, for those of you who don't know. That is always really important reminders, and I always appreciate you. Okay, I'm going to dive right in. So I teach a planned giving class at the master's level, and for 8 weeks, we spend 4 hours together every evening going through some of the things that I'm going to tell you about today. So we're going to do a really basic overview and not drill down too deep. So I'm going to start at the very beginning. Where can your assets go at death? There's 3 places: heirs and beneficiaries, the government, or to charity. Those are your basic 3 places that your assets are going to go at death. Where will they go at death? Well, that depends on what estate planning you have in place at the time you pass. They might go through a will. Wills are subject to probate, which can get pretty expensive. So, and also there's this issue where if you have over 11.4 million in your estate, everything over that, 11.7 million, excuse me, anything over 11.7 million is going to be taxed at 40%. So folks who have those really, really big estates probably going to be out of a will realm and into will replacement strategies like life insurance, trust, whether revocable or irrevocable, and we're going to talk about those later. If you don't have a will or a will replacement strategy, all of your assets are going to be divvied up by the statute of descent and distribution in the state where you reside. So in Oklahoma, where we are, it basically says it's going to go to your next of kin. Usually that's surviving spouse and then kiddos. If there are no kiddos, we're looking at grandpa and grandma, aunts and uncles, and things like that. So a lot of the time, you know, your intent might line up with the statute of descent and distribution, but you probably don't want to risk it. right? We want to make sure our assets are going exactly where we want them to go. So again, 3 places: heirs, the government, charity. Now, if you give to charity, you don't have to give as much to the government. They basically say, hey, you know, it's kind of on the flip side of what Jerry was telling y'all earlier about how, you know, nonprofits don't have to pay taxes. And the IRS says, well, that's basically us subsidizing you because we're missing out on money. It's kind of the same idea, same philosophy with regard to donations to charity. They say, hey, you're coming in and you're working on supplementing what might be a government program if it was not filled by a public charity, if that need was not filled by a public charity. And so they say, if you make a donation to charity, we're going to subtract what you owe to the government with some limitations in about that fair market value of what you gave to charity. So I'm ready for the next slide. Thank you so much. Okay, so philanthropy for me, planned giving for me, falls into 2 different categories. The why, we call that above the line planning, and the how, we call that below the line planning. So this is from a book called The Right Side of the Planning Table by Scott and Todd Fithian that I really, really love. I would encourage you to read it, especially if you're an advisor to folks or if you're an advisor to a nonprofit. But they basically divide this into 2 areas, the why and the how. And you might have thought that I was going to come here today and talk to you all about the how and tell you all about these different entities and what tax breaks they get. And I'm definitely going to do that. But what I want to encourage you to do is think about how the why and how come together to make it more likely that your donor is going to follow through with their plan. So when I say the why, what I mean is what gets your donor emotionally excited, right? What gets them, what gives them that warm, fuzzy feeling. We all know that feeling when we go into the community and we get to do something good that's in line with our values and reflective of what we want our legacy in the community to be. And what happens is donors and nonprofit organizations get in this space where they think that donors are focused on the tax break, and they lose sight of the fact that people are still really interested in that warm fuzzy above everything else. And that warm fuzzy is what motivates them to follow through on the estate plan. Because if you think about it, when we put in place an estate plan, they might be 35, 40 years old. And the likelihood that they're going to follow through just because they got a full tax break at the age of 90 becomes lower when there's not that additional warm fuzzy involved. So I'm ready for the next slide. Thank you. Okay. So I want to talk to you a little bit about the why before we dive into the how. So too often plans are put in place and then the donor never follows through. And the question that we want to ask ourselves is, why are donors failing to implement expensive and time-consuming plans? Like, what is the disconnect? And the answer is the warm fuzzy that we were just talking about. When you bring that into play, you're more likely to get followed through. So my bottom line is this: stay curious long enough to discover your donor's unique motivators. Now, those motivators might be, I love puppies, I love supporting children in my community. But it could also be, I really want to make a big donation to charity, but I still need some income to supplement my livelihood. So I'm going to teach you how to satisfy both of those needs later in the class, but later in our talk. But what I want you to know now is that the warm fuzzy matters. Okay, I'm ready for the next slide. So here are the actual main concerns of wealthy donors. Fear that the gift will lead to being asked for more money. So we can introduce, anonymous gifting in those situations. Fear that the gift may not be used wisely. We can introduce restricted gifts in those moments, right? Endowments. We can set up our own 501c3 with its own individual mission, and then lack of connection to the charity. And this is really where the discernment style, the questioning, the curiosity style comes in, is creating that connection to the charity, creating that connection to the advisor, and things like that. So there is not a fear that donors will not have enough and or tax issues usually. So donors are not giving because they get a tax break, despite what your CPA and your CFP may think. it would be better to start with the discernment style rather than diving right into the how. So step 1 is determine what matters to your donor, the discernment style. And step 2 is to figure out how to get to the goal. So let's move into some questions that I like to use when I'm asking my donors kind of what they want. I'm ready for the next slide. So here's the questions I like to ask. What was the world like when you grew up? What's your greatest accomplishment? If you could change anything in your life, what would it be? Who's the person you admire most in the world and why? What gives you that fuzzy feeling? And then I follow it up. Tell me more about that. How did you feel when that was happening, right? So you can see how we like to employ really open-ended questions so we can give people the space to come to their own conclusion rather than projecting what we think they might want onto them. So I am going to take time to do a 2-minute exercise with you guys because I'm all about interactive talks. So I'm ready for the next slide. And I'm going to give you guys, we're running a tiny bit behind. So I'm going to give you 1 minute to sketch a layout of your childhood home. And even though you're not going to be able to come back and converse with me because I think that we're on mute, I may ask Kelly to be my model, my guinea pig.
Okay, sure.
Is that okay?
Yes.
Okay, so I'm going to give you guys 1 minute, go. And I know I can't see you, but I really hope everyone's doing it because it's kind of cool. I'm literally timing you all. Okay. Okay, and we got about 15 or 20 seconds left. Okay. Kelly, were you able to draw the layout of your childhood home?
Yes, I did.
Okay, thank you so much for engaging with me in this way. I appreciate you. So tell me, when you were drawing the layout, did anything come up for you? Sad, happy, memories at all? What was going on in your brain?
Well, first of all, I was trying to remember which room was which. I come from a really large family. We were constantly changing bedrooms as everybody was growing up. But my happy place was in the kitchen with my mom. And I remember I always wanted to be right next to her, and I'd sit by the oven and watch everything baking inside. So that was kind of my warm fuzzy. If that's
I love that. Thank you so much for sharing that. That's beautiful. So tell me more about what it meant for you to have that space with your mother.
It made me feel safe, loved, seen, just made me feel good and happy to be with my mom.
That's beautiful. And well, and as a child, I think that having that parent who creates the space for that safety builds resilience in ways that I think last a lifetime.
Mm-hmm. Definitely agree.
That was beautiful. Thank you so much for sharing with me. So I just kind of wanted to show you guys a little bit of a way that I kind of engage with people and warm up that part of their brain before I just dive in with those questions that we were talking about earlier. Because coming in that hot don't go so well. And so sometimes I like to do, little activities, kind of get our brains warmed up and establish that trust and connection before we dive into this little bit more, vulnerable conversations and things like that. So thanks for doing it with me, Kelly. I hope that was a little bit of a good illustration of how this might work when I'm out in the world.
Yeah, great.
Thanks. So I am actually ready for our next slide, and we're going to move into the how. So we talked about the why, we talked about staying curious longer. We talked about the reasons that the warm fuzzy matters and how it works to motivate the how that we're going to talk about now. So I want to talk about 2 hows. I want to talk about philanthropic tools and charitable entities, and I want to talk about the charitable deduction limitations. So we're going to dive right into those entities now. Here's just a list And I want you guys to see how many different ways there are to get money, services, time back into our communities. Writing a check, bequesting a will, endowments, supporting organizations, community foundations, board service, volunteer service, starting a 501c3, lobbying our legislatures to protect 501c3s, prizes, donor advised funds, bargain sale gifts. So we're going to go into these a little bit in the next slide. But I just wanted you guys to see how really vast this world is and what a space it is to get creative based on the needs that you identify in the why part of those conversations. So charitable vehicles, 501c3 public charities and private foundations, donor advised funds, endowments. That's generally what we think about when we think of a charitable entity, charitable vehicle. Then we have gifts of partial interest in property, which might be a transaction, might be a charitable vehicle. So we've got life estates, charitable remainder trust, charitable leads trust, charitable gift annuities, pooled income funds, conservation easement contributions. We're not going to talk about all of these, but we're going to talk about the ones that I run into most often. And then we have third charitable vehicle, which are charitable bequest tools like wills that, you know, give a portion of the estate to charity. Life insurance, we can make the charity the beneficiary of a life insurance policy, or we can purchase a life insurance policy with ourselves as the life, and have the charity own that policy, be the actual owner of the policy. So there's a few different ways we can do that. And then other testamentary vehicles like life insurance and things like, or like trust and things like that. Okay. Jerry talked a lot about 501c3 public charities, so I'm not going to go too much into this because she talked to you guys about the regulations on the board and why they're so heavily regulated. And she talked to you about the fact that they have to file a annual Form 990 that has a lot of information in it. A 501c3 public charity is good to use when the donor wants to be heavily involved in programming, actually going out into the community and getting the services done, as opposed to just writing a check or distributing grants to support a cause. So if they're just wanting to do some monetary support, 501c3, not great, right? That's going to be more programming in the community and stuff like that. Donor must also be willing to relinquish control with a 501c3. Jerry talked about an independent board and the need for that. So we're going to contrast that with private foundations now. And I'm ready for the next slide, please. So private foundations are also 501c3s, two types of 501c3, public charity, private foundation. Public charity, they get the best tax breaks. I always say they get the sexiest tax breaks. That's get my students to perk up a little. But they get the best tax breaks, which means they're the most heavily regulated. Now, what we'll see later is private foundations, their tax breaks aren't as favorable, little less regulated. You can have family members on the board. You can pay family members fair market value for services rendered. 501c3, we can't do that out of those. Private foundations must also pay out 5% of their net assets to a qualified organization on an annual basis. Your qualified organizations are public charities and government entities. That's it. So while the public charity is in the community doing the services, doing the things, getting dirty, saving the puppies, feeding the babies, the private foundation is giving them the money to do it. So that's kind of the difference. They don't do a whole lot of programming in the community. Okay, I'm ready for the next slide. So donor advised funds are super cool because they retain some of the control, but none of the administrative burden of our 501c3 public charity or private foundation. A donor advised fund is held either at a community foundation or a 501c3 that has the infrastructure to manage it. And basically how this works, you know, for example, if you were in Oklahoma, we would put your money into the local community foundation. We have Oklahoma City Community Foundation. And at that point, it would be theirs. So you would get to take a deduction because they're a 501c3 public charity. Almost all community foundations are. And you would get to take a charitable deduction for the donation. It would sit in a bank account, essentially, a bank account that is restricted for the purpose of funding 501c3s and government entities. And then you could go in and say, you know what, this year, I think I want 10 grand to come out of my DAF to go support that animal shelter that I really like. And I think I want 2 grand to come out to go support that after school program that I really like. And for the most part, they're going to say yes, unless what you're asking them to do is distribute money to a non-charitable entity. Maybe they lost their 501c3 status. Maybe they were never a 501c3 in the first place, and they're just kind of raising money under the pretext of being charitable, which sometimes happens. So they might tell you no, but it's going to be because it's an inappropriate expenditure, usually. Now, they retain something called variance powers, which is just the right to tell you no. So you do relinquish some control there when you make the donation, but you don't have to file the annual Form 990, right? The community foundation is filing the DAF as part of their assets on their annual Form 990. So it's cool to use for like kiddos and stuff that you want to get involved in philanthropy, but you're not willing to like let them take the wheels with the 501c3 or something like that. But you want to get in there and teach them about doing due diligence, teach them about philanthropy, show them the value of a $2,500 gift to charity and how much of a difference that makes, so that they, you know, I use it as a training tool and as a donation tool for my donors. So I'm ready for the next slide. Okay, let's see. Perfect. Endowments. Endowments are kind of like DAFs. They are they're essentially a restricted bank account, usually held at a community foundation at some 501c3s that have the capacity to administer these. And basically what they do is they say, hey, I'm going to dump a big principal into this bank account, and you can use the growth to support your building, to make payroll, to XYZ. Some of them might say, you can never touch the principal. This is, this funding is in perpetuity. You can only ever touch the growth. So you can see how that creates an ability to give more sustainably, right? Some of them say you can dip into the principal, but only in XYZ situations or only in emergent situations. Okay, I'm ready for the next slide. So we're going to talk about partial interest in property, and we're going to do it relatively quickly. So I'm hoping that you'll have access to these slides, but what I generally want you to know is gifts of a partial interest in property are, the general rule is we don't get deductions for these. So a really good example is let's say you have a building and you're letting a charity use a floor for free. A lot of my donors think that they can then go and take a charitable deduction for the annual, amount of rent that they're missing out on. But that's an example of a partial interest gift that does not give rise to a deduction, because the IRS says, donor, you still have the right to go in there and take that back, right? A landlord can always take back a tenant's access to the property. And because of that retained control, you don't get the benefit of a charitable deduction. That's our general rule. Here's our exceptions. Contributions of remainder interest, charitable remainder trust, charitable lead trust, pooled income funds, charitable gift annuities, and qualified conservation easement contributions. So let's jump right in. Charitable remainder trust. These are pretty complicated to set up, which means you want a pretty big bulk sum of money before you're going to do this. But here's the basics. You donate money into a CRT. It's technically a charitable vehicle, meaning it doesn't, a nonprofit or a tax exempt charitable vehicle, meaning it does not have to pay any taxes. So what's cool about this is you can dump appreciated property that's grown in value into your CRT, your tax exempt entity, and it doesn't have to pay capital gains on any of that when it sells it. So it gets to sell all your highly appreciated property, pay no taxable gains on any of that, and then you get to take a portion of the CRT as income for life. So it'll make a fixed payment to you, usually on an annual basis. And then when you pass, whatever's left over in that principal in the CRT goes to charity at death. Now, there are about 1 million limitations, which means if you're going to do a CRT, you want a lawyer and a CPA together to make this happen. I'm ready for the next one. Charitable lead trust is the inverse of a charitable remainder trust. You put the money into the charitable lead trust, it pays a charity an annual payment for life. And then when you die, it goes to your heirs and beneficiaries. So it's the exact opposite. Little bit of a nuance here. CLT, not a charitable entity. because the donor gets to take it back eventually, right? Whereas with the CRT, it eventually goes to charity. So once it's in there, it's eventually going to make it to charity. With a CLT, it pays for life to charity, and then it goes back to the donor. Okay, I'm ready for the next one. Charitable gift annuities. These work a lot like regular annuities. So you give a big, usually a pretty big bulk sum, usually at least over 200K to charity. And in return, you get the right to receive usually annual payments for the rest of your life. Charitable gift annuities are sticky though, because at the time the charitable gift annuity is created, it's all set in stone. It is all contractual, meaning that annual payment that you have to make the donor for the rest of their life, let's say they live 20 years longer than we think they're going to live, you still got to pay that, regardless of whether the principal is still there or not. So we have state statutes that say, hey, if you're going to take a charitable gift annuity, you need to have a certain amount of assets on deck to back it up in the event that we end up in a situation like this. So these are really for big organizations that are national in nature and that have the assets to back these up. Otherwise, you're going to look at a community foundation that you know has the infrastructure to do these. Okay, I'm ready for the next slide. Life estates in, sorry, just the one previous. Just want to touch on life estates really quickly. This is cool, only for residences, only for farmland, not for commercial stuff. What it says is, hey, I'm going to retain this house, this farmland for life. And when I die, it's going to go to charity. And what's really cool about this is your donor gets an immediate deduction. They get all the warm fuzzy of making a gift, but then they have everything they need to live out the rest of their life in that space before it goes to you. Importantly, if you do take any real property, if you accept this life estate in residence or farmland, you'll want to do an assessment of the property, an assessment of how much it's worth, qualified appraisal, but you're also going to want to sample, if it's real property, the land for any pollution. A lot of charities don't realize that whoever owns the land is technically responsible for remediation, meaning if there's lead poisoning or something like that, and you take it on, you don't know about it, you're then going to be responsible for the cost of remediating the land. So you want to be sure what you're taking is good before you accept it. Okay, I think that brings us to our last slide, which is my takeaways. There's 3 of them. Oh, sorry, we're going to talk about the value of charitable contribution. So I'm going to go through this real quickly. It depends on 3 things: type of organization, nature of the property, and the donor's income. And this is a real simple slide that walks you through all of these rules. We can go to that next one there. So this tells you the different kinds of charity, or the different types of places that it can be donated. One is a 50% charity. That's all public charities and government entities. 2 is a non-50% charity. That's your private foundations, government or veteran organizations, nonprofit cemeteries, and almost all private family foundations. Unqualified organizations that don't receive any deduction for a donation to, those are for-profit and non-charitable individuals, 501c4s, C5s, and C6s. And then here's the different kinds of property that you can contribute, like cash, securities, and ordinary income property, which is like property that you sell in the ordinary course of your business, short-term capital gain property, generally property that you've held for less than a year, long-term capital gain property, generally property that you've held over a year. So that brings us to the next slide, which shows you the rules. So the type of property, organization to which the property is donated, value of the deduction, and then the deduction limitation. So for example, if you donate cash to a 50% charity, you can take a deduction of the cash value up to 60% of your adjusted gross income. Now, right now, that's 100% of your adjusted gross income. And the federal government made that change due to a lot of disasters that had been happening, right? They wanted people to be able to contribute up to cash, up to 100% of their adjusted gross income to help support the folks in Houston and things like that, but also to help with a lot of the financial issues that arose out of COVID-19. So you can see how this walks you through the other rules. Ordinary income, short-term capital gain property to a 50% charity. Your deduction is valued at the lesser of your basis, how much you purchased it for, plus any improvements that you made, less any depreciation that you've taken, that's your basis, or the fair market value, up to 50% of your adjusted gross income. You can see if it's to a non 50% charity, a private foundation, that's only 30% of your adjusted gross income. So you can see how the 501c3, the 50% charities, the 501c3 and government entities, how it could be much more beneficial to make a contribution to them from a tax break perspective. And then you'll see here, capital gain property where the donor elects to use FMV, that might be a little bit of a different limitation, but you can use these. Also, if you run up against the limitation, you can carry it forward for up to 5 years. So let's say you can only take 30% of your adjusted gross income for a donation. And then you can only take that in 1 year, and you have an excess of 20 grand. You can take that over into the next year, and the next year, and the next year, and the next year, and then you're done. If you didn't get it all, you didn't get it all, and it's kind of a use it or lose it situation. I think that brings us to our last slide, which are my takeaways now. If you don't govern where your assets go at death, the state and federal government are going to decide for you. That's one. Second, stay curious longer. If you can, if you're representing an organization or you're helping advise someone in the community, figure out what the donor really wants before you try to figure out how to get there. 3, creativity matters. There's so many different ways to get money and services in the community. If a check isn't on the table, don't be afraid to consider other methods of giving. So thank you guys so much. I think that's all I got for y'all.
That was so great. Thank you so much, Alex and Jerry. And we've got a couple questions in our box that we'll go through since we have limited time, but we'll address those first. And then if there's any time left over, I'm going to ask all mine. So the first one we have would be going to you, Jerry, because it came at the very beginning. And it says, we have a few board members who don't give us monetary donations, but through their professions, provide us free and needed services that would have cost us a whole lot of money if we had paid for them directly. So does that count as a sufficient contribution? I have a hard time wanting to ask them to give more money when they save us so much in their services.
That is a fantastic question. But when you look at the grant applications, they usually say, do you have 100% personal giving from your board? So for instance, when Alex and I both sat on board, so although we may provide free services, we may do some things like that, we always circle back around and write a personal check. Now, somebody may give you $10,000 worth of free services and we love them for it. But a lot of times those grant applications don't ask if it's in-kind donations. They want to know if it's a monetary donation. So circle back around and have them write a check for 10 bucks, 25 bucks, right? That way we're making sure we're being open and honest when we say, yes, we have 100% personal giving from our board members.
Great answer. Thank you, Jerry. So Alex, this question is going to be for you. Our disease is ultra rare and we get limited donations because our pool is so small. We're able to get some significant money from a few sources, including an estate left to us some years back. Since it was more than we needed at the time, we put it into an investment account, kind of a rainy day fund, especially in the event that our biggest donor, who really keeps us going within the giving ratio, will no longer be possible. Is that a terrible thing to have this rainy day fund, or to save for something big like a clinical trial, or does that work against us?
So first of all, from a fiscal health perspective, I'm so glad that you guys have a rainy day fund, because it's really, we recommend that you have at least 6 months of operations in reserves. That's kind of like a touch point of fiscal health. So I would say it's amazing that you have this rainy day fund. I love that you utilize this bulk sum of money to create sustainability. I think that the fact that it's an investment account means it's working in the market for you and not just sitting there, which I really, really like as well. So yeah, no notes. I mean, I think that works great. I can't think of any way that it would work against you other than there may be a PR aspect sometimes folks are like, oh, they're hoarding this money, they're not actually doing the programming or something like that. But in general, that can really be addressed by saying, hey, we have an obligation to be sustainable if we want to keep, performing the services. So I love it. I think it works great for you.
I have a little bit of a follow-up question to that one, because I've been told we can't have more funds in our account than what we budgeted for in the year, because that can look bad as well. Can you speak to that?
I can absolutely speak to that. And this, just so you know, this is a very common misconception. I probably have this conversation 6 or 7 times a year. A lot of people think that nonprofits have to zero out like their bank account every year or whatever to make it look like they're utilizing all the assets. That can be true if you have a federal grant that requires you to spend it down. You have to spend $1 million by this amount of time. So in that context, certainly it applies. Outside of that extremely limited context, it is so important to have those reserves and create that sustainability. The organizations that I've seen that are most, that are really fiscally healthy, they have at least 6 months to a year in their bank account at the end of the year, at the beginning of the year, at any given time.
That's great and good to know. I love having some reserve there because I'm a planner. I don't like going all the way down to the bottom because it's like we don't know what's going to happen in the future. So that's good.
Exactly right.
Yeah,
that's exactly.
So our next question would maybe be for either of you. I know an annual 990 report is required. What about the slit glossy annual reports that charities do? Is this required? I came on after we were already established and not sure what's required versus what people just do. Ours is very basic, but again, I'm not sure why I'm doing it each year.
You want me to take that one, Alex?
Sure, yeah, I can take that. So the annual reports that you create, there's no legal requirement for that, but they really work to support your organization because a lot of donors like to see them. So if you're getting, a lot of donors are moving away from just writing a check, right? And they want to move into, well, what's the return on my investment? They're kind of starting to just categorize it that way. And so you can then use these kind of glossy annual reports to say, if you give me money, here's the return on your investment. Here's what it's going to look like. Here's how many people we've touched in the community. Here's how many lives we've changed. And if you give me X amount of dollars, I can touch this many more people and ensure this many more ripple effects happen. So it's not necessarily a requirement as much as it is a good, sustainable fundraising tool.
I'd like to add a little bit about that. You guys heard Alex mention donor advised funds. So what happens when we file those 990 tax returns? Let's say you've got 5 million, setting over in your money market account, and that shows up on your tax return of just cash on hand. So it looks to donors like you don't need any money. And so that's the issue that we kind of run in with that. It's obviously we want you to have lots of cash on hand, right? But some organizations will actually start a donor advised fund at their community foundation, sweep their 5 million over into that donor advised fund. And then when it's time to build their building or when it's time to do that big research project, they can get that money back out to support that project, but they get it off their tax return because donors look at that tax return and that tax return should be used as a marketing tool for you.
That's super interesting. I had no idea you could do that. But then could that community foundation dip into those funds? No.
So this is why in this specific instance, I recommend a restricted endowment that says this can only be utilized to support this organization. Because that additional restriction on the endowment that's not necessarily present in the DAF can help guard against that very real risk that you just talked about. So it's it would totally be appropriate to put it in a DAF, and especially if you had a really good working relationship with that community foundation and had reason to trust that that was going to be, and you had a good contract in place. Outside of that, though, I would think that you would want to go with the restricted endowment that has an endowment agreement that says, this is when we can jump into the principal. This is when, but this money is to support this specific organization in perpetuity. What do you think about that, Jerry? Do you?
No, I agree with that. I agree. And it's making sure, like Alex said, a good contract.
Mhm.
So we know if we're going to dip into the principal on the endowment, and that has to be contractual in nature. Otherwise, you may not be able to dip into the principal.
Okay, great. Thank you. And then a comment in the chat box was, and it was after our last question, but this organization was dinged by the BBB for having a sustainability fund. We didn't make this one of their standards because of that. Any
BB
thoughts?
should call me.
Yeah,
Because they wrong.
they're wrong.
And that happens sometimes.
Oh, man.
Yeah. So, I mean, they legitimately, like, you should give them my number. I would love to send them an email because I come against this all the time, and it makes it so hard for our organizations to be successful in the community. And it is not a best practice. That's the most important part. It is not a best practice not to have a sustainability fund. And it amazes me when we go back to that kind of philosophy. So yeah, I'm sorry that you got dinged on that, and would be happy to talk to whoever about that.
Okay, so another one says the BBB dings you for having more than 3 years of expenses in the bank.
That's that's when you need to use that endowment that Alex has been talking about, or the DAF, depending on the contractual relationship with your community foundation.
So if an organization would want to go ahead and do that, what steps would they need to take to make that happen if they don't have any experience? Would they need legal advice or like a CPA to set that up?
I would call your local community foundation. I would price a couple of them because I bet there's 2 or 3. And I would figure out what their pricing is, talk to the representatives there, and then I would, kind of figure out what the most sustainable option for you is going to be. I'd pick one, and then I would call your lawyer, because it's going to be pretty easy, pretty cheap to set up an endowment or a DAF at a community foundation, but you're going to want the attorney that only represents you only to look over that contract that Jerry was talking about, that governs, here's when the money can come out, here's what we can use it for. You'll want your own legal representative to bless that before you sign it.
Okay, and so one other question. So the investment account should go to either an endowment or a DAF, and not sure I understand what the difference between the investment account and an endowment.
So I completely understand the confusion because they're very, very similar. A donor advised fund gives the donor the right to advise where the money goes at any given point. So the money can go, they might say in 2017, they want an animal shelter, and in 2018, they want their church, and in 2019, they want something else. An endowment specifies the purpose at the outset and then is set in stone. So it's not as vulnerable to, them coming in and taking it, kind of like you were talking about, Kelly. Because with a DAF, the community foundation still retains what we call variance powers. And remember, that's the right to tell you no. With an endowment, you determine how it's going to be spent. And they would have to tell you no at the time of creation if they were going to ever tell you no, versus later with a DAF. Does that make sense?
Mm-hmm. Yeah, that's good. Thank you. So we have just a couple more minutes, and I had a question from what you were speaking on about bylaws, Jerry, earlier. Because I know we as a CSD have been making some little tweaks to ours. My question is, at what point do you need to report to the IRS or on your 990 about any changes made in your bylaws? So what is minor, what is major?
Yeah, and it's interesting because the IRS calls them significant changes. But a significant change could be that we have a range in our bylaws from 11 to 21, and we're going to go from 11 to 24. And the IRS considers that substantial. So the list of what the IRS considers substantial is on about page 20 of the 990 instructions. Now, depending on how you pull up the instructions or whether it's going to be on page 19, 20, or 21. So right in that area is where the IRS is going to define significant changes. Okay, if you're unsure, give it to your CPA and tell them, please check if this is a significant change that has to be reported.
Okay, that's great. Just writing some notes. All right, does anyone else have any other questions that they would like to bring up? We've got 2 more minutes. I'm just double checking with that. We've covered everything. I think we have. Well, this has been wonderful, ladies. Thank you so much. It's great to have your expertise and have the opportunity just to have an ongoing conversation about some of these issues that can be really hard to untangle. So appreciate it, and hope you all have a wonderful rest of your week.
Thank you guys so much for having us. This is my favorite kind of work, and I really appreciate you trusting us with it. So
Thanks, everyone. Bye-bye.
Bye.